So today we're going to be taking a look at other people's investing portfolios. So what we're going to do is jump onto a platform called M1 Finance and take a look at these portfolios and see how they're kind of set up. Now, I do have an M1 Finance group, which is where I got all of these different portfolios from, as well as some of the questions that some of these users have sent me. Now, this is actually my second episode in the series because I've done one already, pretty much all the same here for us, so I'm just going over the second part here. Now, this episode is also brought to you by Earnest, which is a student loan company that allows you to refinance your student loans entirely for free. So if your interest rates are way too high, make sure you check out the link down below to go ahead and refinance your student loans entirely for free. And the nice thing is you do get a bonus for using my link, and you also support the channel so I can continue to do free stuff just like this for you guys. All right, so this first one says here, it's kind of tough, but overall, would like you to see as a new investor to see if I'm doing everything correct and if I got good picks. I don't have any ETFs or index, just growth and dividend stocks. I do have a Roth I max out already and have VTI there. So that's a really good thing to know. So that way I can kind of, have that in the back of my mind. And maybe advice of what you would do or change in my taxable account. Really anything that can help me in the long run. So let's go ahead and load up this portfolio and see kind of what we're looking at here across the board. So this right over here, I like to kind of just see the performance in the 1 year. This is essentially just based off of an initial investment of $100 from the 1 year marker. So this is not their actual performance. This is just the performance of if they invested a year ago, where it would be right now. Let's see here in the 3 years, it's 65%, still pretty much close. And then in the last 5 years, it would be 317. So that's pretty solid there. As I mentioned, they already have a retirement account. So we're just kind of looking at this as, hey, I want to grow my money. So we got 29 holdings, which is awesome. Not too many to pretty much, split your money too thin, or not too little to have too much risk. So I like that a lot. The dividend yield here is 2.83%, so that is pretty solid there. Doesn't sound like they're mainly focused on dividends, but what that does show is that we have some good income coming in, whether we want to reinvest it or not. And then, of course, zero expense because we don't have any ETFs. So if we look here, we can see we have NVIDIA as the majority of this fund. We got some Waste Management, some Walmart, McDonald's, Coca-Cola. So already there we can see there's a lot of diversity. We got some tech, we got industries, we got retail, we got food, we got customer goods. We have health right over here with Pfizer, AT&T with communications. So I could already tell that this portfolio is pretty well balanced for having 29 stocks. Of course, we got Tesla, so we got some really good opportunity for some growth there. We got Disney. We got a REIT in here. We got Gap, Berkshire Hathaway. So we got a lot of these companies over here. There is obviously a little bit of a break here with the percentages for targets. So we have 11% for NVIDIA, and then all the way down here we have like 1% for Berkshire Hathaway. That's not necessarily a bad thing, but just obviously just kind of something to keep in mind. You're at least very close to what I personally have for my stuff, which is no one fund is more than 10% of my overall portfolio. For the most part, obviously, if it goes to 11 or 12, that's fairly close, but I don't want to do something like 40% of my portfolio into one stock like Tesla or something like that. That's too much risk for me personally, and I wouldn't want to do that. So just kind of something up there. We have a slice over here that's 5% of the portfolio that has some additional companies. So just kind of curious why the Apple stock and Microsoft and all of these are separated. Maybe there's a certain reason for it, which is what I actually love about M1 Finance the most, is grouping things up how you see fit, which is cool because then you can see their performance is separate from the overall pie or portfolio, I should say. And so that to me is really, really cool. So you got Apple in there, which I was kind of wondering where it was, and then Microsoft as well too, which is huge. We got Facebook, Netflix, Amazon, some really good powerhouse companies that are, really going to potentially grow the portfolio. And then we got like Bank of America, Sony, which I know there's some opportunities for like Sony and whatnot, but obviously across the board, I think these are really solid companies in this pie right over here. So I do like that. And then we have one more down over here that's called Other. And then this one here has an additional 8 stocks right over here. So we have Starbucks, Texas Instrument, Pepsi, we got a couple of these different companies. So solid companies across the board here. My only thing with this other pie is because it is only 1% of their portfolio. And then when you click in there, there's the 8 companies. These companies probably don't get a lot of funds when deposits come in, making it really hard to get any of the value extracted from them with the growth that they might have. So just something to keep in mind when going through this, that very low percentage is going to make it really hard. Like sometimes these might not even get deposits, and even if they do, the percentage is really low on that front. So overall, solid portfolio. Didn't have any questions when it came to their overall stuff, just asking for that advice. I mean, as far as changing anything, I don't know if I would change anything in this portfolio. Personally, obviously there's maybe different companies that either I don't know about or like personally that I wouldn't have in there. But as far as the style that you're trying to go for, like that's solid. It's great across the board. I like it. If I was invested in this, I wouldn't be disappointed for the different companies across. So next up here, it says, I will be 42 in November. I started the account at or around March 29th of 2020. In the heart of the market sell-off, which is actually kind of cool. It says, it is a taxable account. I knew absolutely nothing about stocks until I came across a video on YouTube. Then I started watching more videos, reading books, and researching companies. Came across your YouTube channel, which, by the way, they came across my True Financials channel. This is more of the investing journey. It says, learned about M1 Finance and opened the account. I believe one time I had over 53 companies in my portfolio, and then after further research, I have scaled my equities back to about 14 portfolio, including dividends and growth stocks now. I have invested about $1,800 to date so far. I had to back off a little bit on investing recently due to finding out my wife's pregnant. Congratulations. And we are going to be welcoming a baby boy in December, my second boy. Awesome. It says right here, after I get things squared away, after the baby is here, I plan on going back to investing $200 per month again. However, currently I've scaled back to about $100. I also have a 401k through work, but plan on investing in a Roth through M1 as I have retirement accounts from previous jobs that I would like to roll over, which is really a great thing to try to roll over that stuff if you can. It says the main goal is for passive income over time so I can enjoy retirement in about 18 to 20 years. So let's go ahead and load up this portfolio and let's take a look and see how everything is going on here. So this is awesome. I'm pretty excited for this one. So it shows right here in the last year, again, this is all hypothetical. If they had $100 deposited, it would be up 70%, which is stellar. Over the last 3 years, it's up 71%. Obviously, the big dip there you can see. And then the last 5 years, 144%. So that is really good stuff. So he mentioned about 14. There's 15 here. Dividend yield is 3.368, and then no expenses because we don't have any ETFs in this account. So here we have a couple different slices. So we can see here they're pretty much broken down evenly here across the board, which is cool. So we have from 17% on the travel and leisure, and then we have about 15% in financials. So let's go ahead and take a look here. So in the first one, in the travel, we have the 4 holdings. We have Royal Caribbean, MGM. We also have Seder Fair, and then Carnival Corpse. Now all these are broken down across the board evenly. Obviously, there's a high dividend yield, but that's also because of the the prices going down on these funds here altogether. Now, in the 1 year marker, this sector here is down about 42%. Obviously, this has a lot more risk with it, just because even though the prices are down, doesn't mean that everything's going to go back up to normal. Obviously, that is the hope. If it does, I'm assuming, because you said you bought in March, so you bought somewhere down here, which is super nice. So you could get some really amazing gains if they get back to even close to where they were prior. For me personally, it's a little too risky in my style of investing, but still can work out for a lot of people, and I know it has already in some aspects worked out for some people in those areas. Now for tech, you got AVGO. I'm personally not too familiar with them myself as far as how they're performing with their stock and everything. But of course you got Apple here, which I love. I have Apple as actually my main holding with Microsoft in my portfolio. This stock has done amazingly well. If we take a look here, does it show percentage? Yeah, 98% in the last year. I mean, you quite literally doubled your money if you bought a year ago. Obviously, you bought in March. So let's see here. Does it? No, 6 months is too much of a cutoff. So in March, if you bought in March, you bought at $63. After the split, it's $124. So you're making good money on your Apple stock there. So that's looking really good there. We got some real estate here. Now, we got quite a few different companies with real estate. So we got Realty Income, we got Gambling and Leisure Properties, FRT, and then FRT does, I think they, if I'm not mistaken, they're the ones that do a lot of like the retail properties. And then we have the MGM growth properties. So what I do like about this is that for the most part, these are also fairly diversified from one another when it comes to what they're invested in. So that's really good to have that, that there across the board. So it's still down for the year, but I think that one's going to have a little bit more of a slower creep back up. But again, if you're buying now, you're getting it at a good price. All right, and then we got the consumer staples here. So we got Tesla and we got Amazon. Fantastic companies. With Tesla, it's still pretty risky, but I think long-term Tesla is going to be a fantastic company to have. I know I have them as a small portion as well. Same thing with Amazon. So both of these companies I think are good ones to hold on to. Communication services. So we got Facebook and we got AT&T. I do like that you're keeping a lot of this stuff pretty even across the board in each of these different pies. And so we got, these two are really good. AT&T, it just sucks because if you look at them and their performance over the last 6 months, they're down 6%, down quite a bit for the year. And I mean, they have a really good yield right now, but that's pretty scary for most companies. AT&T I'm not as worried about just because they've been around so much longer. But just something to keep in mind there. And then, by the way, I do also have AT&T. So, that's just my look at it. But I think it's still good based off of the percentages you have for everything and how it's all split up. And then you got financials here, which you got M&T Bank. Not too familiar with this company, but overall, looks like they've been having a hard time recovering as well in this area. So my only thing would be to kind of look more into that company in the financial pie there, just to see if they're worth keeping for long term, or if there are other financial companies that might have some better growth opportunities. For me personally, just looking at this, if I had this portfolio, I would probably kind of slow down on the travel and leisure side of things and maybe start bumping up some other areas to maybe get some more opportunity for growth, because we saw how Apple had this amazing growth since the downturn in the market. And having more invested in them would have potentially yielded more results, but hindsight's 2020. It's a good opportunity, of course, to always reconsider which options might be the best for you, because obviously keeping everything as it is, you're still going to do very well. I think very long term, this portfolio is going to be very solid. You have a great dividend yield now at 3.36%, but it's going to keep going up as companies are paying out additional dividends by growth, which, you have a lot of companies that tend to do that anyways. Like Microsoft and Apple tend to have really good dividend growth across the board. So yeah, I'm pretty happy with this portfolio. It looks really solid across the board. All right, so this next one says I put in $30 every Thursday, which, by the way, I love being very consistent like that. That's great. Says I'm growing it into an income stream. I want to produce at least $1,000 a month, which is awesome. And the question they did ask says, I don't know which one to go with, which is an IRA or a Roth IRA. Now, they're going to ask not necessarily for this pie we're looking at, but just in general. And to kind of go with that, they did say that they are 35 and want to retire in about 10 years. Obviously, with investing with retirement stuff, both a Roth and a Roth IRA do have limits of when you can start pulling money out. So pulling money out in 10 years wouldn't be feasible. Obviously, you can focus in on your taxable account because you can start using that whenever you want. And then the retirement can be for later. Now, to answer that question, first and foremost, I personally think both options are fantastic. And I know that's not an answer people want to hear. But for the most part, no matter which one you go with, you're going to benefit from it tax-wise. But for me personally, I think if you have longevity when you can actually pull that money out, which it sounds like you do, a Roth might be more advantageous, because if you can't cap out every single year for sure, that's why that would work better. But if you can max out every single year on your IRA, technically both of them will do almost the same thing, or unless you think that taxes are going to be much higher when you retire, which in that case a Roth might be a better option for you. But yeah, again, if you can max out, it technically wouldn't make a difference, but if you can't max out every year, a Roth might be a little bit more advantageous at that point. All right, so let's take a look at this portfolio here. And what we're going to do is take a gander. So it looks like 19% over the last year, which is what we like to look at. And then the 3 years, 46%. And then the last 5 years, 101%. So not too shabby over there. Obviously, we're going to be looking at creating passive income, which is a fantastic thing to know. We have about 64 holdings in here. For me personally, this was quite a bit when I started having a large set of holdings. I talked about this before in like previous stuff where for me personally, I wanted to start cutting back on my holdings only because after so long, I kind of came to the realization that I couldn't really have an impact on the funds I was holding versus the ones that were just kind of sitting there getting nothing. Now, the reason for that is because a lot of the funds were not getting any money into them. So I had, quite a bit of holdings and some of them just got nothing while others got a larger fund. So for me, I cut it back to around like 30 funds. Not saying that people have to, but that's just the preference I ended up taking. So this one has a dividend yield of 2.825% and then an expense ratio of 0.03%. So we got about 13 slices in here. So we'll kind of run through these a little bit. So we got first and foremost real estate at 10%. So we can see here 9 holdings. So we got like Realty Income, we got Public Storage, great company. We got DLR, fantastic. We got FRT. So we got some really good REITs in here. Quite a bit of them all together across the board. So kind of like we talked about earlier with the amount of funds, one thing to just keep in mind is that being so split up across everything makes it a little tougher, especially because we did mention the number that we're depositing every week, which is that $30, makes it hard for a lot of these companies to get almost anything out of that $30 deposit when you have that many funds. So just, again, something to keep in mind long term. And then we have this one called My First Pie right over here. So you got Microsoft and Apple, fantastic companies. This one right over here is 10%. So that's, for me personally, I like that because that means each one of those is getting a large sum when it comes to the deposits, as long as they're still under target. And then we got this ETF sector here. So we got the SPY, which is the 500 ETF trust. We got DIA. We got VOO, and then we got QQQ, and then this one right over here, which is the Dividend Aristocrats. So one thing to keep in mind with these is that the expense ratio is a little high there, which is 0.17, when you consider that a lot of them are quite a bit lower than that expense ratio. That's just money that you're paying on the back end that you can't really see. So just kind of something to keep in mind there. Personally for me, and I talked about this before with ETFs, is that a lot of times there's certain ones here that are going to be overlapping, such as these two here, and then there's certain funds in these ones that are kind of overlapping with like one another as well too. So something to keep in that back of the head is like, do I want all these funds, especially with, the deposits every week getting split into 5 of these, might not be as advantageous as if having just like 1 or 2 of them. Me personally, I just have the one ETF that I have in my portfolio and I like it. It just makes it easier for me to manage because that way everything just kind of goes into that one by itself. We got bonds here. So we got 4 different bonds. Me personally, I'm just not the biggest fan of bonds right now. Just at the age that I'm at over 31 years old now. And for me personally, I don't see a lot of opportunity for bonds. Like if you look in the last 5 years, this has gone up 19%. When you compare that to your 5 years here, which is 100%, that's 5 times more that you're getting with your overall portfolio than the bond fund. Now, I get it, bond funds are less risk, but for me personally, I will get into bonds possibly as I get much, much closer to retirement, like maybe within like 5 years of retiring or needing the money. But while I still got like 15, 20 years to go, that kind of stuff, like I'm just going to go for it and be more risky with that. But by risky, I just mean being more into like the ETF of the S&P 500. So we got a tech pie right over here. We got some holdings. So we got IBM, Google, Intel, Amazon, Google again. So you got both Googles, by the way. Honestly, these 2 Google things, just as a FYI, don't really do anything different from each other rather than just having different voting rights. I would personally just not have both. I would just go with one. They perform almost identical. Then we got Tesla, which is awesome, and then Alibaba. So pretty good across the board, except for having the 2 Googles. I wouldn't personally do that. If we go into the food here, we got some solid companies here across the board. We got Kraft, we got Domino's, Starbucks, McDonald's, Pepsi. If you want a little bit more growth on this one, with less dividend for now, you should check out Chipotle. Chipotle has always done really, really well. Obviously, they had a downturn from like 2015 with their issues, but they still have some amazing growth right now. So consumers, Clorox has done very, very well during the whole world downturn. We got Costco, we got Home Depot, Target, some really solid brands across the board here. So this little pie here looks pretty good. Let's see here, utilities. So we got ED, we got D, and then SO, so pretty solid. I'm not too familiar with a lot of energy companies. I actually just bought into one energy company recently, but I know that these companies are fairly popular ones to have in a portfolio. So healthcare, we can take a look here. So we got United, Omega, Johnson & Johnson, AbbVie, and then Merck. So these are pretty solid across the board. Some good dividend yield there as well, so that's always a good thing. And then communications, we got Verizon, AT&T, and T-Mobile. Obviously, these two right over here are solid. Cutting that off. Solid dividend companies. I mean, paying out some really good numbers. We talked about this with AT&T is 7.3%, so that's pretty high. But performance on the stock has not done very well. So industries here, we got the likes of Waste Management, Honeywell, Caterpillar, and 3M, all 25%. So that one is looking pretty solid there. And in the financial sector here, we got Visa, MasterCard, JP Morgan, Capital One. So I mentioned earlier about like having obviously a lot of different funds and less going into each. So this is one thing I did was companies like Visa and MasterCard are in very, very similar, company as far as what they do. So what I did was I did a little bit more digging and research into both of these companies and said, you know what? It's great to have both. It's definitely not harmful. But because, especially when I was first starting, I was doing $10 a week. And I said, hey, I can't do a lot into each one. Why not just do more into one and hopefully getting that money to really start growing for me? So that's what I ended up doing. I got into one and left the other. And the same thing can be said for Pepsi and Coca-Cola. Like I had both of them for a long time. And I, again, did the same thing. I researched, I looked at both, and then I made a conclusion to say I will invest into one versus the other. Not because the other one's bad, but just because the other one tends to do better for the goals that I want to achieve. And then down here we have gold. I talked about it a little earlier. I'm just not the biggest fan of gold myself. Obviously, they've done well. You can see here in the last 5 years, actually better than your overall portfolio, but I'm not a gold person myself, but the fact that it's a small percentage of our portfolio is always a good thing. Less risk. I just don't hold gold myself. But yeah, that's looking pretty good. I mean, not the best dividend yield, but still really good performance across the board I think that's actually the best gold I've ever seen. Now, as I mentioned earlier, I'm going to have my link down below for refinancing your student loans, so don't forget to check that out. And if you're interested in joining in my investing club on Facebook, go ahead and check out the link in the show notes as well, so that way you can get started. Now, I want you to keep on learning when it comes to investing, so check out my next video right over here. My name is Dennis, and I will see you in that next video.